Ladies and gentlemen, the American guy here, gold just broke above $5,000. Let me say that again so it sinks in. Gold is above $5,000. Right now, gold is trading at $527.40. That's up $61.40 on the day. The percentage gain is 1.24%, but that number, 1.24%, doesn't capture what just happened. Gold failed at $5,000 three times in the last week. 3 times it tried to break through. 3 times it got rejected. And now it's through. It's at $5 through 27.40. And silver? Silver just rallied over 5%. It's at $81.86 right now, up $4.17. The percentage gain is 5.36%. From the $63.98 low we saw just yesterday, silver has rallied 28%, 28% in 24 hours. Platinum is up 0.67% to $2,113. Palladium is up 1.55% to $1,708. The entire precious metals complex is green. Everything is rallying. And the technical analysts at FX Street are now saying silver bulls are eyeing further gains near $82.00. They're pointing to the 200-period simple moving average at $86.25 to $86.30 as the next target. And beyond that, the 50% Fibonacci retracement at $92.95. So here's the question everyone's asking. Is this it? Is this the moment when the correction ends and the bull market resumes? Is gold breaking $5,000 the signal that we're heading to $5,500, $6,000, maybe higher? Or is this a trap? Is this the same setup we've seen before where gold breaks a major level, everyone gets excited, retail piles in, and then the rug gets pulled and we crash back down? I don't know the answer. Nobody does. But what I can do is show you exactly what the data is saying, what the technicals are telling us, and most importantly, what you need to do right now before this market either explodes higher or implodes lower. So shut up, pay attention. Let me walk you through the most critical 15 minutes of analysis you'll hear this week. Let's start with gold because everything in precious metals flows from gold. Gold is the anchor, gold is the safe haven, gold is what central banks buy, and gold just broke $5,000. Current price, $5 at $27.40, up $61.40. Percentage gain, 1.24%. Now, 1.24% doesn't sound like a lot. That's a normal day for silver. But for gold, breaking a major psychological level like $5,000 after multiple failed attempts is huge. Here's the context. Over the last week, gold tried to break $5,000 3 times. First attempt, hit $5 through 92.70, got rejected, crashed back to $4,050. Second attempt, rallied back to $4,972.40, got rejected again. Third attempt, pushed to $4 through 966, couldn't hold. Each time, the sellers stepped in. Each time, the bulls got crushed. But now, gold is at $5,027.40. It's above $5,000. It's holding. And that changes everything. In technical analysis, when a major resistance level breaks after multiple failed attempts, it often leads to a strong move higher. Why? Because all the shorts who were betting on the rejection are now getting squeezed. They have to cover. They have to buy. And that buying pressure pushes the price even higher. Plus, all the bulls who were waiting for confirmation are now getting in. They didn't want to buy at $4,900 and get rejected at $5,000 again. But now that $5,000 is broken, they're convinced. They're buying. So you get this combination of short covering and new buying that can create explosive moves. But here's the cynical take. Breaking $5,000 doesn't guarantee we stay above it. We could be at $5 through 27 right now and back at $4,950 tomorrow. Resistance becomes support, but it has to be tested. And until gold can hold above $5,000 for multiple days, we're not out of the woods. Now let's talk about silver because this is where the real volatility is. Silver is currently at $81.86, up $4.17. Percentage gain, 5.36%. But let's put that in context. Yesterday, silver hit a low of $63.98. Today, it's at $81.86. That's a $17.88 gain from the low. That's a 27.9% rally in roughly 24 hours, 28% in one day. This is the silver that people love and hate. When it goes up fast. 5%, 10%, 15% days. But when it goes down, it's equally brutal. We've seen 12% down days. We've seen 22% intraday swings. So yes, silver is up 36% today. And yes, it's rallied 28% from the $63.98 low. But before you start celebrating, remember that silver was at $121 just weeks ago. Even at $81.86, we're still down 32% from the peak. This isn't a recovery. This is a bounce within a larger correction. And until silver can reclaim $90, $100, and ideally break above $121, we're still in the aftermath of a massive crash. But the rally is real, the momentum is real, and the technical setup is starting to look bullish. FX's Street just put out analysis saying silver bulls are eyeing further gains near $82.00. We're currently at $81.86, so we're basically there. But the interesting part is what comes next. They mention the 23.6% Fibonacci retracement. Without knowing the exact range they're using, I can infer they're measuring from the $121 high to the recent low. Fibonacci retracements are levels where the price often finds support or resistance during a correction. The 200 period simple moving average is at $86.25 to $86.30. This is a key resistance level. The 200 period SMA is one of the most watched moving averages in technical analysis. It separates long-term uptrends from downtrends. If silver can break above $86.25 and hold, that's a major bullish signal. And beyond that, the 50% Fibonacci retracement is at $92.95. This is significant because the 50% retracement is often where corrections end and the prior trend resumes. If silver can rally from $81.86 to $92.95, that would be a 13.5% gain and would put us very close to reclaiming the psychological $90 level. So the technical roadmap is clear. $82 is happening now, $86.25 is the next test, and $92.95 is the level that would confirm the correction is over and the bull market is resuming. But here's the reality. Technical levels are not guarantees. They're probabilities. Silver could rally to $86 and get rejected. It could rally to $92 and get rejected. Or it could blow through both and head straight to $100. Nobody knows. The market will tell us. But the technicals give us a framework to watch. It's not just gold and silver. The entire precious metals complex is green today. Platinum is at $2,113, up $14. That's a 0.67%. Palladium is at $1,708, up $26. That's 1.55%. When all four major precious metals are rallying together, it suggests this is not just a silver or gold story. This is a broader safe haven bid. This is money flowing into the entire sector. Why does that matter? Because it suggests the rally is being driven by macro forces, not just technical or speculative factors. Something is happening in the broader market that's making investors want to own precious metals. Maybe it's concerns about the economy. Maybe it's geopolitical tensions. Maybe it's fears about the banking system or currency devaluation. We don't know what the specific catalyst is because the news doesn't tell us, but the fact that platinum and palladium are both up suggests this is real money coming into the space, not just retail speculation. And that's bullish. When institutional money flows into precious metals, it tends to be stickier than retail money. Institutions don't panic sell. They accumulate over time, they build positions, and they hold. Let's talk about the $63.98 low we saw yesterday, because this is the most important question right now. Was that the bottom? If $63.98 was the bottom, and we're now rallying back above $80, then this is the moment to buy. This is the generational opportunity. You buy at $80, hold through $90, $100, $1 to 10, and you make life-changing returns. But if $63.98 was not the bottom, if we're just in a dead cat bounce that's going to fail at $86 or $92, then buying at $80 is a trap. You'll watch it rally to $85, get excited, and then watch it crash back to $65 or lower, and you'll be stuck underwater again. So how do you know? You don't, not with certainty, but you can look for clues. Clue number 1, gold breaking $5,000. If gold can hold above $5,000, that's bullish for the entire complex. It suggests the worst is over. Clue number 2, silver breaking above the 200 period SMA at $86.25. If silver can break through and hold above that level, it confirms the uptrend is resuming. Clue number 3, volume. If this rally is happening on high volume, that suggests real buying. If it's happening on low volume, it suggests it's just short covering or weak hands repositioning. The news doesn't give us volume data, so we can't use that clue yet. But we'll know in the coming days. If you buy silver at $81.86 right now, here's what you're betting on. You're betting that $63.98 was the bottom. You're betting that gold holding above $5,000 is sustainable. You're betting that the rally to $86.25, $92.95, and beyond will happen. You're betting that the fundamentals, the deficit, the industrial demand, the central bank buying, will reassert themselves and drive the price higher. And you might be right. All of those things could happen. We could be at $100 next week and $120 next month. But you could also be wrong. So what's the risk reward? If you buy at $81.86 and silver goes to $92.95, you make 13.5%. If it goes to $100, you make 22%. If it goes to $121, you make 48%. But if it goes back to $63.98, you lose 22%. If it goes to $60, you lose 27%. The upside is clearly bigger than the downside in percentage terms, but that doesn't mean the probability is in your favor. If there's a 30% chance of upside and a 70% chance of downside, you're still in a bad bet. Let me play devil's advocate. Let me make the bear case for why this rally could be a trap. Bear point number 1, we've seen this before. Bear point number 2, silver is still 32% below the $121 peak. Even at $81.86, we're not close to reclaiming the highs. This could just be a correction within a larger downtrend. Bear point number 3, the volatility is extreme. When you see 28% rallies in 24 hours, that's not healthy price action. That's panic buying, short covering FOMO. And those moves tend to reverse just as violently. Bear point number 4, sentiment is fragile. OCBC said it themselves just yesterday. The market is sensitive to the dollar, to yields, to macro forces. One strong dollar move, one spike in yields, and this rally could evaporate. Bear point number 5, retail is probably buying this rally. And retail is usually wrong at major turning points. When retail is excited and buying, that's often the top. When retail is despondent and selling, that's often the bottom. Right now, retail is getting excited. That's a contrarian red flag. Now let me make the bull case, why this rally could be the start of the next leg higher. Bull point number 1, gold broke $5,000 and is holding. This is not a fake breakout. This is a real move. And when major psychological levels break after multiple failed attempts, it often leads to strong follow-through. Bull point number 2, the entire complex is green. This isn't just silver speculation. Gold, platinum, palladium, all up. That suggests real safe haven demand. Bull point number 3, the fundamentals haven't changed. The 658 million ounce silver deficit is still real. Industrial demand is still growing. Central banks are still buying gold. The supply constraints are still there. Bull point number 4, the $63.98 low could have been a capitulation event. That's when the last weak hands panic sell and the smart money steps in and accumulates. If that was capitulation, then we've already seen the worst. Bull point number 5, the technical setup is bullish. If silver can break above $86.25 and reclaim $92.95, that would confirm the correction is over. And once that confirmation comes, the FOMO will be massive. Everyone who sold at $70 or $75 will be scrambling to get back in. Here's what I think the smart money is doing right now. They're not all in long, and they're not all in short. They're positioned for both scenarios. If gold holds above $5,000 and silver breaks above $86.25, they'll add to longs, they'll scale in. They'll build positions, as the trend confirms. But if gold fails at $5,050 and silver gets rejected at $86, they'll cut longs and possibly go short. They'll take the other side. They'll sell into the rally. This is what professionals do. They don't predict, they react. They don't bet everything on one outcome. They hedge, they position for multiple scenarios, and they adjust as the market gives them information. Retail does the opposite. Retail picks a side and goes all in. I'm bullish, I'm buying everything. Or I'm bearish, I'm selling everything. And then when the market doesn't cooperate, they get destroyed. Let's talk about the levels that matter going forward. FX Street mentioned the 200 period simple moving average at $86.25 to $86.30 and the 50% Fibonacci retracement at $92.95. These are the levels that will determine if this rally is real or fake. $86.25 is the first major test. Silver is currently at $81.86. That's $4.39 away. If we can rally 5.3% from here and break above $86.25, that's bullish. It means the medium-term downtrend is broken. It means the 200 period moving average is no longer acting as resistance. But if we rally to $85 or $86 and get rejected, that's bearish. It means the sellers are still in control. It means the 200 period SMA is doing its job as resistance. If we do break above $86.25, the next target is $92.95. That's the 50% Fibonacci retracement. This is huge because the 50% level is often where corrections end. If we can rally from $81.86 to $92.95, that would be a 13.5% gain and would put us very close to the psychologically important $90 level. And if we break above $92.95, the bulls are fully in control. At that point, we're probably heading back to $100, maybe $110, maybe even retesting the $121 high. But these are all ifs, big ifs. The market has to actually do it. And we've seen plenty of setups that looked great on paper but failed in reality. Everything I just said about silver's technical levels assumes gold holds above $5,000. Because if gold fails at $5,000, if it falls back to $4,900 or $4,800, silver is going down with it. Gold and silver are correlated. When gold rallies, silver usually rallies more. When gold falls, silver usually falls more. Silver is the leveraged play on gold. So the single most important thing to watch right now is whether gold can hold above $5,000. Not just for a day, but for multiple days, for a week, for 2 weeks. If gold is still above $5,000 next weekend, that's a strong confirmation. That means the breakout is real. That means the bulls are in control. But if gold is back at $4,950 or $4,900 next weekend, that means the breakout failed. And if the breakout failed, the bears are probably going to take control and push us lower. All right, let's get to the action plan. What do you actually do based on where you are? If you're holding physical silver or gold from before the crash, you hold. You've survived $121 to $63.98. You've seen a 47% drawdown. This rally to $81.86 doesn't change your long-term thesis. Your timeline is years, not days. So hold. If you panic sold at $70 or $75, don't FOMO back in at $81.86. I know it hurts. I know you're kicking yourself, but if you buy back now and we get rejected at $86, you'll be underwater again immediately. Be patient. Wait for confirmation. Wait for silver to break above $86.25 and hold. Then consider getting back in. If you're thinking about buying for the first time or adding to positions, dollar cost average, don't go all in at $81.86. Buy a small amount now. Set limit orders to buy more at $78, $75, $72 in case we pull back. And set orders to buy more at $87, $90, $93 if we break out higher. Spread your entries. Don't bet everything on one price. If you're trading with leverage, take partial profits if you're long from lower levels. If you bought at $70 and you're up 17%, take some off the table. Lock in gains, move your stop to break even. Don't let a winner turn into a loser because you got greedy. And for everyone, the most important thing is to stay flexible. Don't marry your position. Don't fall in love with being bullish or bearish. The market doesn't care about your opinion. It only cares about supply and demand. So follow the price. Respect the levels and adjust as new information comes in. Let's come back to platinum and palladium for a second because they're giving us important information. Platinum is up 0.67% to $2,113. Palladium is up 1.55% to $1,708. These are smaller moves than gold and silver, but they're moves nonetheless. Platinum and palladium are primarily industrial metals. They're used in catalytic converters, electronics, jewelry. Their price is driven more by industrial demand than safe haven demand. So when platinum and palladium are rallying alongside gold and silver, it suggests two things. One, there's broad-based buying across the precious metals complex. Two, there's optimism about industrial demand, which is a proxy for economic health. This is important because one of the bear arguments against silver has been that if the economy weakens, industrial demand for silver will collapse and the price will crash. But if platinum and palladium are rallying, that suggests the market isn't pricing in an economic collapse. It's pricing in something else, maybe inflation concerns, maybe currency devaluation concerns, but not economic collapse. That's modestly bullish for silver because it means the industrial demand thesis is still intact. After analyzing all the data, here's my verdict. This rally is real in the sense that gold broke $5,000 and is holding, and silver rallied 5.36% to $81.86. Those are facts. But is this the bottom? Is the correction over? Is it safe to buy aggressively? I don't know, and neither does anyone else. What I do know is that the technical setup is improving. Gold above $5,000 is bullish. Silver approaching the 200-period SMA at $86.25 is bullish. The entire complex being green is bullish, but we've been here before. We've seen rallies that looked promising and then failed. We've seen breakouts that didn't hold. We've seen FOMO-driven moves that reversed violently. So my advice is hope with caution. If you believe in the long-term thesis, use this rally to accumulate slowly. Dollar cost average. Build positions over time. Don't try to time the perfect entry. If you're a trader, respect the levels. $86.25 is make or break for silver. $5,000 is make or break for gold. Watch those levels. Trade based on what actually happens, not what you hope will happen. And if you're on the sidelines, wait for confirmation. Wait for silver to break above $86.25. Wait for gold to hold above $5,000 for a week. Don't rush in just because of one green day, because the market will give you plenty of opportunities. If this rally is real, you'll have time to get in. And if it's fake, you'll avoid a trap. This is The American Guy. It's Sunday, February 9th, 2026. Gold broke $5,000. Currently at $5, they're 27.40, up 1.24%. Silver rallied 5.36% to $81.86. From the $63.98 low, that's a 28% bounce in 24 hours. Platinum up 0.67% to $2,113. Palladium up 1.55% to $1,108. The entire precious metals complex is green. FX Street says silver bulls are eyeing $82.00, with the 200-period SMA at $86.25 to $86.30 as the next target, and the 50% Fibonacci retracement at $92.95 beyond that. Is this the bottom? Is the correction over? Nobody knows. But the technicals are improving. The levels to watch are clear. $86.25 for silver, $5,000 for gold. If we break above and hold, this could be the start of the next leg higher. If we get rejected, we're probably heading back down. So stay disciplined. Don't FOMO. Don't panic. Dollar cost average if you're accumulating. Use stops if you're trading. Wait for confirmation if you're on the sidelines. The market will tell us what's real and what's fake. But it won't happen overnight. It'll take days, maybe weeks, to know for sure. Until then, manage your risk. Preserve your capital. And don't let one green day make you reckless. This is the American guy. Trade smart. Stay alive. And we'll see where this goes.